Good morning. Welcome to Share Market Mike. Today we will talk about sovereign gold bonds. In this video, I will try to explain my understanding of the scheme sovereign gold bond issued by the Reserve Bank of India on behalf of Government of India. We will also do a comparison on the returns from investment on physical gold and in sovereign gold bonds. So we will have a comparative study with an example. This is all based on my understanding. If you feel this scheme is good for you, before you proceed to invest, kindly double check all the details in the RBI website. Before proceeding any further, a request from our side. If you liked our videos, kindly support us by hitting the like, subscribe and share button. We shall start from the basic. What is a sovereign gold bond? Sovereign gold bond is a government security issued by Reserve Bank of India on behalf of Government of India. So it is similar to investing in physical gold, but we do not actually invest in physical gold but in this sovereign gold bond. So if you have decided to invest in gold, then you may consider sovereign gold bonds as an alternate. It is more secure because it is being issued by Reserve Bank of India on behalf of Government of India. The scheme was started in the year 2015. We shall quickly go over the features of sovereign gold bond. When we invest in sovereign gold bond, that investment earns an interest of 2.50 per year. This is paid into our bank account semi-annually, which is once every 6 months. The tenure of sovereign gold bond is 8 years. There is an option for us to exit after the 5th year. When we exit or at the end of the tenure of 8 years, we will get the returns linked to the gold prices at that time. So what is the minimum investment we can make is for 1 gram and maximum investment is 4 kgs. This is for individuals, 4 kgs for Hindu undivided family and 20 kgs for trust. So when we say per year, it is from April to March. Sovereign gold bond is available both in demat and paper form. Purchasing sovereign gold bonds is also pretty simple. We will see that in the following slides. Continuing with the features, there is zero risk of handling physical gold when we invest in sovereign gold bond because there is no physical gold involved at all. 2.50% annual interest is paid semi-annually. The capital gain tax is completely exempted. So this is a very positive sign. The assurance is also there on the purity of the gold, which is 999 purity, which is 24 karat, published by the IBGA. These sovereign gold bonds can be used as collateral for loans. Some of the banks accept it. The nomination facility is also available in sovereign gold bonds. So the question arises, how can we invest or purchase sovereign gold bonds? Should we reach out to RBI? The answer is simple. We can do it through our banks. Most of the banks allow us to do it through net banking online or visiting the banks. Even post offices are offering sovereign gold bonds. Even you can buy or sell in the stock exchanges, but the liquidity in stock exchanges will always be a question. So if you are investing for a long term as an investment, then always preference is to do it through the banks or post office. Now let us try to compare the return on investment while we invest in physical gold and the same amount if we invested in the sovereign gold bond. This is my understanding of how sovereign gold bond works. So if you feel this is a suitable investment for you and you are trying to make an investment, ensure the details are double checked on the RBI website before you make the investment. Now let us quickly go into the story. Let us assume Supandi and Dora decide to invest in gold. Supandi is going to invest in physical gold and Dora is going to invest in the sovereign gold bonds. Now let us assume the gold's per gram price is 4,190. So this is just an assumption. So Supandi is going to invest in physical gold. Let's assume he is going to purchase for 10 lakhs. So we assume the per gram price is 4,190. So Supandi is going to buy 238.66 grams of physical gold. Will the amount stop there? No, he has to pay additional charges for making charges and the losses, and then he has to pay other expenses like tax. So he's going to pay more than 10 lakhs for 238.66 grams because he's going to invest in the physical gold. Then it doesn't stop there. He has to rent a bank locker to keep all these physical gold. So that is also an additional charge. We assumed Dora is going to invest in sovereign gold bond for the same amount, which is 10 lakh rupees. So per gram price is 4,190. Dora is going to invest for 238.66 grams. So is there any additional charges? No, because there is no making charges and losses, and there is no other expenses like tax, and Dora doesn't have to spend for bank locker. Now, after 8 years, let us try to see what is the returns on investment for Supandi and Dora. Let us assume after 8 years, the gold price per gram is 4,692. We know both of them invested for 238.66 grams. So the worth of it after 8 years becomes 11,19,792 rupees. So it is the same for both of them. But remember, Supandi paid more than 10 lakhs because of the losses and the making charges and for the bank locker. And then the yearly interest that the sovereign gold bond gets, Supandi doesn't get because he has invested in the physical gold. So let us assume yearly interest at 2.5 percentage. Dora would have got 25,000 for a year. So now for 8 years, if we calculate that, Supandi doesn't get that. Dora would have got 2 lakh rupees. One important catch here is Dora has to pay the tax for the interest that she earned through sovereign gold bond. There is a capital gains exemption in the tax, but there is no exemption for the interest that is earned. So that is a catch, that Dora has to pay the tax for the interest earned, but Supandi doesn't earn any interest because he has invested in physical gold. Now the total net worth after 8 years becomes, for Supandi it is 11 lakhs 19,792. For Dora it is 13 lakhs 19,792. Now making charges and loss, Supandi has paid the charges for that, but Dora has not paid, and locker charges also Supandi has paid, but Dora has not paid. Now on the long term tax, there is an exception for Dora, but Supandi has to pay the tax for the long term gains that he would gain once he sells at the end of 8 years. With this, we have come to the end of the video. This is my understanding of how sovereign gold bond works. If you have any questions, please do write them in the comment section. I will try to answer them. If you find our videos useful, kindly support us by hitting the like, subscribe and share button. Thank you.